In this video, we're going to focus on the negatives of Orca. Those are the fees that you pay, but also the risks you take from lending your money to third parties via these peer-to-peer platforms. And what would happen if the UK economy takes a nosedive? What's the worst case that could happen? Let's see what Iain says about that. Okay, so one of the things that I focus on a great deal is fees, because often it's difficult to find out what the fees are because they come from multiple sources. And if you have a platform, there's kind of lots of places where the fees can hide. So what I'd love to know is what fees you have with Orca. I mean, how do you charge the fees? Because presumably you get a fee and then the individual funds get a fee.
Sure. So we charge users or investors on our platform 0.65% of the investment that they have on the platform annually. We also charge the P2P platform. So we make a referral fee from it for every investor that we refer. So that's our revenue model. In terms of the charges that the investor pays at the underlying platforms, it's actually quite difficult often to determine how much the P2P platforms charging, and that is because unlike a fund manager where it could be 1.5% or whatever the fee is, with peer-to-peer lending, the fee is the differential between the investor rate of return and the how much the borrower is paying, and that spread between the two is quite often difficult to determine because the structure of the loan can be quite different. So for example, the borrower might pay 2% upfront and then 1% over the course of the year, or whatever the fee structure is. So the fee structure can be quite complicated in peer-to-peer lending and probably not that transparent. What we're finding now is the FCA are really trying to push for transparency on the amount of differential between the investor rate and the borrower rate. So we'll start to see that coming into the market probably in the next 18 months or so.
Okay, so now a difficult question, but I'd love to know the answer. Does your referral fee conflict with the best interests of your investors?
It's a very good question, and it's something that we are very conscious of. So we put our investors at the forefront of what we do. Ultimately, it's more important the investor's behavior on our platform than the referral fee. So what I mean by that is how much they invest, the products that they go into, than how much we make per product. So we're very conscious about providing a good quality service to the investor and trying to remove that factor from the equation. Now, what we would say is longer term, what we would like to do, and I suppose just ultimately the reason that we take the fee from that side as well is so that we can charge a lower fee to the investor. So we believe 0.65% is relatively good value for this kind of product and the service that we provide. And if we didn't charge on the other side, we would have to charge the investor more. So that's why we do it.
So if there was a situation in which you had two funds, one gave you a big fee and the other one didn't, but they're pretty much equally matched, obviously you'd go for the one which pays you the higher fee.
Well, we're big believers. So our platform is an aggregation platform. So ultimately it's the user's choice. So we would probably put both on the platform and then let the user decide. In that situation, what we find is the type of provider that might pay you a large fee isn't the type of platform or type of provider that you want on your aggregation platform anyway.
Okay.
So they wouldn't get on in the first place.
Okay, so let's just talk briefly about risks. So let's say, we've had this period since 2005 when peer-to-peers existed, when we've had global equity markets rallying.
Yeah.
We had global economic growth starting to recover from the crash in 2008, 2009. some of the peer-to-peer platforms have been through that cycle, but most haven't. And most of the investors in the platforms have never seen a recession. So let's just talk about what can go wrong.
So what I would say as well is a lot of the investors, actually, the average age of the investors in the market, it's between, it's typically males. It's typically 50 plus year old males. So a lot of them, yeah, not quite there yet. But that's typically who's investing in peer-to-peer lending. And the average investment, it's about £9,000. And I think that's why we're not seeing, people sometimes, what I believe incorrectly, think that's millennials and, peer-to-peer lending or equity crowdfunding, but it's actually more sophisticated investors than that. So they have been in a recession, they do understand it, but what would happen with peer-to-peer lending in those kind of market conditions is, it's a great question to ask, as ultimately that's the big test for peer-to-peer lending. So if we talk about Zopa, who was founded in 2005, they did go through the 2007-2008 crisis, and ultimately investors still earned a return. So the default rate didn't grow large enough for investors to lose money on their principal. It just ate into the interest, and yeah, we did see yields drop, but ultimately investors did earn a return. And why was that the case? Well, at that time, Zopa was operating in kind of virgin ground, if you like, and the borrowers were really good credit-worthy borrowers. Now, what we've seen since 2010, you had Funding Circle and RateSetter join the market, and then we've now got, there's up to over 50 peer-to-peer platforms. There's a lot of peer-to-peer lending platforms. So are all these platforms lending to highly credit-worthy borrowers? Well, some of them probably not. So what would happen in that crisis? Well, we wouldn't see the direct effect on the equity markets. I think what we would see is a delayed effect on the peer-to-peer lending market, where, over time, as unemployment rates rose, you might see default rates rise in the consumer lenders, property prices, drop, or the market becomes liquid. The property lending might suffer, and then the business lending, similarly, insolvency rates. The big question is whether the default rate rises and just consumes all the yield that the investors earning. And on some platforms, we probably will see that, where investors lose money. And other platforms, my belief is that they will still earn money, but modest amounts, and it won't eat into their principal.
The question I'd have about diversification, because one of the great things about your platform is that it does diversify across different types of peer-to-peer lending, so it does mitigate your risk. But let's say that the UK economy takes a nosedive.
Yeah.
If that happens, there's not going to be anywhere to hide, is there? Because it'll spike default rates for business loans, for property loans, and for individual loans, presumably. So they'll all be highly correlated, and the default rates will spike in all of them. So diversification may not help you in that situation if it's only UK products, if it's only UK loans that you offer. Is that true?
It's true to a certain extent, but even within the platform, so it would be true if the type of lending would all had the same risk profile. So if we take a platform that we have integrated with Orca, Landsby, they've lent over 100 million worth of loans. They've not had a default, and the reason they've not had a default is because it's actually quite secure lending. It's to buy-to-let landlords who are, it's almost mortgage lending to professional landlords. So would we see, losses on Landsby? We might see defaults rise, but we don't think that we would see, material losses. And actually, they've been through stress tests, Bank of England stress tests as well to kind of prove that. Whereas other platforms, if we take Assets Capital, which is linked to our platform, it's a lot of it's development finance, a lot of it's business lending as well, where you might start to see like a stronger default rise in those kind of conditions. So even within the industry, it's not dependent on the product and the risk profile of the product, or the type of lending will determine whether people lose money during the crisis.
Now, one of the other types of risks that you'd get for a new asset class, I think you could almost call it, is that regulation takes the time to catch up with the practice. So it may be that the FCA steps in and does some kind of draconian measure on peer-to-peer lending, and there could be other regulatory risks, right, for peer-to-peer.
More for the industry as opposed to for the investor, I would say. So if you peer-to-peer lending, it grew. It was an unregulated product for a long time. The large platforms grouped together and formed an association, the Peer-to-Peer Finance Association, and they came up with kind of standard principles almost to self-regulate. And then as time passed, the FCA brought in a new regime specifically for peer-to-peer lending. So there's a specific type of regulation just for peer-to-peer lending, and that came into play. And now we're going through our review period to see if the regulation that the FCA put in place actually is fit for purpose. So we're having there's a consultation period going on at the moment with the FCA, where they are tightening up on regulation. So the difficult thing with the FCA at the moment, or the challenge that I believe that they have, is they're really trying to push forward with innovative financial products such as peer-to-peer lending. I mean, the UK is one of the market leaders. Certainly in Europe, the amount of lending in the UK through peer-to-peer lending, 80% of the European market is really the strongest peer-to-peer lending industry, and really we're at the forefront of that. What we've found is, there's lots of different business models evolved. Some have provision funds, property lending. It's very diverse. There's quick access accounts. There's a lot of different products on the market for the investors, and there's still a lot of innovation to come, in my belief. So the question for me that I find quite interesting is it the right time for the regulator to clamp down on the sector? And in some things, I think there's merit in some of the things that they've proposed. For example, standardizing statistics, making sure investors can understand fees. I mean, these are all great things. There's another thing that the FCA have proposed, which is to restrict the actual audience that peer-to-peer lending platforms can market to. So that would be to put marketing restrictions for non-sophisticated investors, essentially.
Kind of like a hedge fund. Hedge funds aren't allowed to advertise either, are they, to retail investors?
Yeah, so we probably not to the same extent as that, but certainly, there would be restrictions. We believe that that's taken the peer out of peer-to-peer lending, and ultimately, this is it's a great opportunity for investors to earn stable, predictable returns. It's a great opportunity to diversify a portfolio, and we think that it is suitable. Another thing that we believe is that investors actually understand peer-to-peer lending. Lending funds to either other individuals or businesses, and I think that's a great thing. And so I don't believe it's a good idea to restrict who can access this product.
So Ian's fairly upbeat about the UK peer-to-peer market surviving a downturn in the economy, and he's not too keen on draconian measures from the FCA because it would take the peer out of peer-to-peer. Now let's turn to the question of seeder funding, because it turns out they've just had an injection of capital. Let's find out what they're going to do with that.